So a lot of you know that throughout the year, I've been coming back to this particular site, which is FinViz. The thing I like about FinViz is that it allows you to look at the commodities markets. But what I want to do is dig deeper and look at the individual contracts that I call the Forex Market Pulse. So what we're looking at right now is the dollar index. And for me, this is a must for Forex analysis, because if you think back on those pairs that you probably analyze and trade most often, I'm guessing if it's reflective in any way of what I do, the pairs that you look at in some way have a relationship back to the US dollar. And therefore, in my opinion, it's very important that we look and see what's happening on the US dollar. And a lot of people, again, kind of dismiss it because they think, oh, you know what, I'm a Forex trader. I'm not necessarily interested in what happens in the dollar. And that's, I guess, understandable. You know, I mean, in terms of what we all look at as far as what's important in our trading day, I think in some shape we start thinking about calendars and whatnot. Now, if we are to, you know, here's the dollar index, okay? If we are to consider what's important to us and prioritize it, you know, part of, I think what's very important, obviously, is making sure you check what the headlines of the day are. You know, for me, that means a quick run over to, say, Reuters or Bloomberg or any kind of news aggregating website where you can just get a feel for what's dominating the headlines and the tone. An economic calendar, that's a must. And then also my list of musts is looking at what the dollar index, I'll also include the Dow Jones Industrial Average. I like to also look at the Dow Jones Futures, crude oil, the Commodity Channel Index. Okay, for many of you, you might look at gold. I don't know that gold is the barometer that it used to be in terms of the fear and greed, because the speculation still is very much, I think, alive and well in this market at this elevated price. Sometimes I'll even take a look at copper. Copper's been an interesting market to watch. Okay, but really the main markets begin with the dollar, the Dow. Again, we'll throw in Dow Futures, Continuous Commodity Index, crude oil. Now, the Continuous Commodity Index might be something that's new to a lot of you, or not necessarily familiar. And the easiest way that I can describe what this is imagine, if you will, the S&P 500 of commodities. In other words, we're looking at the sectors in the commodity futures. We're looking at the individual contracts within each sector, and it's turned into a giant average. So again, the S&P 500. Now, just like the S&P 500 has different weightings for different stocks and different sectors, so too does the CCI. So when we look at the CCI here, one of the things that you need to consider is that, generally speaking, when commodities are moving higher, it's usually reflective of the dollar moving lower, or in this case, as we see the dollar still within the uptrend, we're going to see that pressures commodities and pushes them lower. When the dollar is stronger, it has more buying power, more strength. It's typically also reflective of a slightly more fearful environment. Okay, not necessarily. Okay, a strong dollar does not always indicate fear, but the strong dollar does typically pressure commodities. So you'll see generally speaking, commodities moving lower with that strong dollar. Now, how do you describe then what's happening with crude and what's happening with the dollar? This is an interesting trend as we round out 2011, which is the strong dollar and strong crude. Now, I've heard a lot of people say that they are interpreting this as an overall reflection of some sort of consumer confidence. Now, if I'm going to see consumer confidence, as soon as I hear that word, or those two words, consumer confidence, for me, I immediately want to run over to equities, because when consumers are, generally speaking, confident, that means they're also confident, typically, investors. A confident investor is going to buy equities. So equities should be benefiting from an environment of consumer confidence. But here's where the stars are not lining up, because typically consumer confidence should not equate into a strong dollar. Not the way the psychology has been playing out for the past handful of years. In fact, when we're really clicking, the dollar and the Dow have that inverse relationship, which we don't have, as you can see here. Now, the Dow is clinging to, I won't call this a strong uptrend, as we're looking at these year-end trends in the Forex Market Pulse, I will not call this a strong uptrend in the Dow. But what I will say, what I will view this as, is bullish sentiment and momentum. I do feel we have bullish sentiment and momentum on this daily chart. And I focus in on the daily specifically because of the fact that I feel the daily time frame, as compared to all the other time frames, is most reflective of the largest psychology, and that's where I also get my directional bias for a particular market from. So, bullish sentiment and momentum, I think when we look at the grab candles, still plotting green, we can confirm that. But the kind of lack of smoothness in the wave, the lack of really an established 12 to 2 o'clock wave, make this a shallow uptrend at best, not a lot of bullish clarity in the trend. And also, let's not forget that we're coming up to an area where the market has exhausted before. But we can't take the current price action. Again, we're talking about this being a year-end review. We can't take the current price action without considering the ramifications of the year-end and what that could do to equities, as there may be what's known as window dressing that has already taken place, may continue to take place. And that window dressing is simply, simplistically this. We're looking at managers, fund managers, who are going to have to create their year-end reviews, answer to their investors, and if certain names, if certain stocks have had good years, a good year, I should say, they've done well through 2011, they're going to want to show, one, ownership of that, and probably more ownership of that, kind of regardless of the price. It's called window dressing because it's just there to kind of make it look good. Does that make sense? I know a lot of you are probably already familiar with this concept. It's just meant to make the holdings look good. And a lot of times those positions are unwound in the first quarter, even within the first month of the new year. So this window dressing oftentimes comes part and parcel with the Santa rally. So could this be that Santa rally / window dressing we're seeing with these tremendous moves higher? Could be. Could it exhaust here? I find this current candle very interesting. Right there, the candle from yesterday, Tuesday. You can see here it's a doji. Now, if I head on over to the YM contract, which is the futures, I can get a better idea of what's happening pre-market. Okay, it's a slightly different chart in terms of the price and where prices have exhausted. But I think what I'm seeing here is one of two things. If this doji is just a pause, then we could push up higher. I'm not going to rule that out. But in the context of the rally we've seen here, this could very well be the exhaustion candle. That's how we typically look at dojis, right? Exhaustion. So could this be a pull back towards this area, into this area of resistance? I mean, we have established a new high here with that as compared to the previous highs here, where we had topped out before. Okay, you can see here, the trading on the 23rd did drive us up through that. We can't neglect the volume. You know, volume isn't something we necessarily talk about a lot on the Forex side of things because we really can't put our finger on that. This isn't a centralized exchange. I can't put my finger on volume the way I can in stocks or in futures. And a lot of this movement in the Dow has been, in commodities in general, you'll probably hear about it, you've probably heard it over and over again if you're watching any kind of financial news television. You know that it's been something that's been just constantly mentioned, and it's important to know. A lot of this move's been on very low volume, and low is comparative, right? There's no number that this says now, you know, this is low. Remember, it's all comparative, and comparatively speaking, the volume's been low for this move, which means the participation has been low. But regardless, I have to respect this, and I have to acknowledge this as the Santa/window dressing rally that is very common towards the end of the last month of the year. So when I come back to this idea of consumer confidence, when I come back to question whether or not that's really what's driving this market, the stall in the dollar index could be reflective of that. You can see here the dollar index broke up higher, and it does have support, but it's not pushing to higher highs, is it? You know, part of an uptrend is what? Obviously, the backbone of an uptrend is support, and that's where I use my 34 EMA wave to identify on pullbacks where an uptrend will find support. Again, defining that backbone. An uptrend line is also another way of saying, okay, here's the backbone of the uptrend. But the continuation of the uptrend is really dependent upon that sentiment and momentum remaining bullish, and that's reflected in a push to higher highs. At some point, if we stop getting higher highs in an uptrend, we're going to lose that enthusiasm for pushing the market higher. And you get what we're seeing right now, which is a market that's probably still in an uptrend, but it's lost a lot of its mojo, hasn't it? You can see the support, the backbone's still in place, but the push for higher highs is gone. In fact, most recently, in the very near term, we actually have lower highs. But the backbone in no way has even been tested. We haven't even come down to the 20-period simple here. Forget the wave. We haven't come down to the 20-period simple. So this is something I'll watch. This stall in the dollar is not necessarily a strong pullback in the dollar as the Dow has pushed up higher. So you have to ask yourself, do participants, generally speaking, in the larger market really buy into this idea of consumer confidence? Because if they did, one argument could be, shouldn't the dollar be selling off a little more visibly here versus just stalling? Or do participants say, yeah, this is simply window dressing? The CCI has had a pretty good little set of sessions here. The commodities in general have actually sprung to life a little bit and moved up higher. We've heard a lot about crude oil back up above 100, but would I call that an uptrend in crude? Again, we've had a series of very strong sessions, kind of reminiscent of the way the Dow has accelerated higher. But is this an uptrend in crude, or are we currently within a sideways trading range? My argument would be that we're in a sideways trading range, and the range has actually dropped. We did have a low back here. I think we re-identified where that low could be in terms of the range, and this is, I think, where we're sitting, in this area. We have a mix of greens and reds and blues in terms of the grab candles, which shows very little organization in terms of the market sentiment and momentum. And then add to that sideways 2 to 4 lumpy looking 34 EMA wave, which further punctuates, I think, the fact that we don't have a trend, or at least clarity in the trend, on this time frame. We were in an uptrend, so I'm not going to dismiss the fact that the momentum that led us here was certainly bullish. But currently, we've lost that bullishness. The wave was broken. We stopped pushing to higher highs, and subsequently the wave started to move sideways. So again, let's go back to one of the arguments we keep hearing, that consumer confidence is returning. Again, another reason for me to question the validity of that statement, and another reason for me to question whether or not the rally in the Dow is really one that we could carry into next year, into January. Now, throughout all this, what I want to make sure I do is keep an eye on the fact that I've drawn these support and resistance levels, because those are going to be the levels at which I gauge whether or not the market sentiment could accelerate or whether or not it's going to stall and or reverse. I don't want to ignore these levels in the charts, because that's where I'll know I'm right or wrong. You know, prices sucked back underneath that red line that I've drawn there. We know that we're looking at exhaustion, and that Santa rally / window dressing rally is probably all complete. And trading might resume into some sort of sideways range. But if we are able to find support at and above those previous highs, that's the bulls stepping in at resistance that the bears had once created. And I have to acknowledge that, and then realize that maybe my expectation of further chop and resistance is then wrong. So we have to have these lines and levels drawn on the chart to gauge whether or not the analysis is right or wrong. Because these levels are decision levels. And all that a decision level is what we commonly call support and resistance. But we all know that just because we've drawn a line in a chart doesn't mean the market's even going to acknowledge it exists. We don't know that there's going to be some sort of reaction. The market could accelerate, stall, or reverse. We draw all these lines and levels in anticipation of one of those things occurring, and then we further analyze the market trend to understand which one of those three is most likely to occur. In the context of an uptrend, I would expect support to hold. I would expect resistance to be broken. In the context of a downtrend, I would expect resistance to hold, and I would expect support to be broken. In a lack of any kind of trend, a lack of clarity in a market, kind of like what we're seeing in, say, gold right now, although we're looking at bearishness, I think we could see a little bit of a area of support in this area. This may not be a good example of that. I think that the Dow would probably be a better example. Not a lot of clarity, some bullishness, but again, I would expect there to be exhaustion. I'll expect there to be exhaustion until there isn't. The market will prove me wrong by accelerating through this level. So it's so important to have these lines and levels, these potential decision levels on your chart to gauge whether or not your analysis is valid, is remaining valid. Because we realize that my analysis of the Dow Santa rally possibly exhausting, and that doji that we see on the industrial average, not the futures contract, but the industrial average, indicating maybe an exhaustion to reversal, all those are contingent on what? The bear selling pressure coming in, right? If it doesn't come in and we accelerate, or if we find support at the resistance level that we had created back here, then I have to say, well, price action is proving my hypothesis wrong. This is a high of, and again, it's on the Dow, of 12,284. 12,284. So what I'll do is I'll make sure I have 12,284 in the properties. Just like that. And what I'm looking at now, and I've expanded this view here so you can see a little bit better, what I'm looking at now is whether or not this doji, which is occurring pretty much around that previous high here, is this indicative of the selling pressure that's to come? Or could this be a rallying point? Don't assume you know. Don't assume. Just know that this is a level at which the battle is being fought. And then gauge and acknowledge who the winner is. You know, I think one of the bigger mistakes, especially in a market that's lacking a clear trend, is assuming you know who the winner is going to be. We don't know the outcome of this market. That's what makes trading so hard, right? We don't know what's going to happen. All we can do is have hypotheses. And just like a scientist has a hypothesis, they also know when that hypothesis is proven wrong. I think that's where a lot of traders, that's where the wheels fall off the wagon for them. They don't know how to define, either by some sort of dollar pain point, by some sort of percentage pain point, or a level on your chart, which is the latter. The very last one is my preference, a level on the chart. You know, you need to know when your hypothesis is proven to be invalid. And here's where that red line, that 284, is going to be really important to me. Between 284 and say 12.3, the major psychological level, there'll be a battle there's a battle being fought. In fact, this high on the day was up at 12.328. 12.328. So, you know, near term, I could say that's where the battle's being fought. 12.328. It's kind of a minor level, but it's one that I think would be worth watching, because that is likely where the bulls and bears are going to try to sort out who's going to take ownership of this level. Is it going to become support? That means the bulls won. Is it going to become resistance? That means the bears won. In this lack of a clear uptrend, but certainly plenty of bullish momentum, for me, I'm still leaning towards pulling up an indicator, like a stochastics, and viewing this area as overbought. It's what's been working in this 2 to 4 o'clock 34 EMA wave environment, and I'll continue to expect that. But again, how do I know I'm wrong? Support above 284, support above 328, support above the major 300. That's when I know I'm wrong, regardless of what that indicator is telling me. Now, why is this Forex Market Pulse so important? Why have we spent so much time on the Dow and the dollar and taking a look at crude oil and the continuous commodity index, a little bit of gold? Because this is, in my opinion, where a lot of the Forex pairs are going to find direction. We know that relationship between the dollar and Dow can indicate whether or not the dollar is able to start pushing up higher again. It's likely not to start pushing up higher until the Dow exhausts. If you're a ComDoll trader, Aussie US dollar, dollar Canada, that crude oil chart and commodities in general are charts that you're going to want to watch, because looking at the dollar Canada, the loonie's going to have a difficult time keeping a strong posture against the dollar without strong crude oil. Same with the Aussie. The Aussie's going to have the Aussie US dollar. That pair, the Australian dollar's strength against the dollar, is contingent in some ways upon what's happening in crude oil. Now here's where it really comes together. If crude is strong, that typically means what? There's risk appetite. If risk appetite's strong, that typically means what? Stronger equities. Stronger equities will usually mean what? The dollar's moving down lower. The dollar's moving lower, crude's moving higher. Who benefits? The loonie, the Aussie, right? So you have to go back and ask yourself, what are these relationships? Because I think it really does have a tremendous amount of impact on your Forex trading. And it's just a handful of charts that really, in many ways, define and allow you to see the nuances of the global economy and what is a currency but a stock of a country, right? So the global economy is very important to understand. Do I understand all the nuances of international economies and how they interweave? Not in any way. I don't even know that most people can you see these experts who do nothing but analyze these countries. And look how often they get it wrong. And they've got hordes of researchers, and that's what they do for a living. They just analyze the global economies, how they interact, who's strengthening, who's weakening, and even they get it wrong. So do I want to even put my hat in that ring? For me, the visual and the more understandable approach is to look at these handful of key commodity futures contracts and find out when they're all clicking. In other words, when they're lining up together, or when they might be indicating that there's a little bit of confusion in the market, or that one group of participants has a particular agenda and another group of participants is just stepping back and seeing what's going to happen. I think that's very interesting in terms of the Dow and dollars relationship right now, because the Dow's just kind of stepping back and saying, okay, the dollar's stepping back and saying, okay, Dow, I understand you want to rally, and I got a pretty good idea. This is just a Santa rally, not really a reflection necessarily of inherent strength in equities. It's probably the window dressing. But we'll know that's wrong if this area of resistance is taken out. So it's a lot of scenarios. It's a lot of potential scenarios that you want to have in your mind. And those scenarios are defined by what? The prices we see in the charts and the lines and levels we draw on them and the relationship of these markets back to one another. The dollar really retreats, which it really has not shown it's doing yet. The dollar really retreats. I think that puts more credibility in the move in the Dow to mean something other than that window dressing and Santa rally. If it does not, I think that has window dressing written all over it. All right, so that is a wrap up of the Forex Market Pulse as we wrap up 2011. Hope it was insightful and gives you some better quality questions to ask yourself as you're searching for those potential trades.